In the early 2010s, WeWork emerged as a symbol of modern work, transforming drab office spaces into vibrant hubs promising community and innovation. Founded by Adam Neumann and Miguel McKelvey, it quickly captivated investors and the media with its ambitious vision for the future of work. From its inception, the company pursued aggressive expansion, planting its flag in cities worldwide, seemingly unstoppable. This rapid ascent culminated in a valuation that reached an astronomical $47 billion, cementing its status as one of the world's most valuable startups. Yet, beneath this glittering facade of success, a fundamental vulnerability was taking root, one that would ultimately unravel the entire enterprise. Adam Neumann and Miguel McKelvey's vision for WeWork extended beyond just providing desks. They aimed to foster a global community. The Wall Street Journal reported on this early mission, noting that the founders articulated a desire to create a shared experience rather than merely transactional office rentals. This focus on community-focused workspace resonated deeply with the burgeoning startup culture and the increasing demand for flexible working arrangements. It was this powerful narrative that helped WeWork attract significant attention and capital, positioning itself as a disruptor in a traditionally state industry, promising not just a space, but a belonging. At its operational core, WeWork's business model was deceptively simple: lease large office buildings, renovate them into trendy coworking spaces, and then sublease smaller units to freelancers and companies. However, as the Financial Times documented, a crucial structural weakness lay in its lease commitments. WeWork signed long-term leases, often for 15 years or more, locking in significant fixed costs. In stark contrast, it offered its clients highly flexible, short-term memberships, some as brief as a month. This created an inherent mismatch: long-term liabilities against short-term, variable revenue streams, a fundamental flaw that would later prove catastrophic. WeWork's ambitious expansion was largely fueled by an insatiable appetite for venture capital, with SoftBank and its Vision Fund becoming its most prominent backer. Masayoshi Son, SoftBank's CEO, invested billions, driven by a belief in WeWork's exponential growth potential and Neumann's charismatic vision. This influx of capital enabled WeWork to aggressively acquire new properties and expand globally at an unprecedented pace, prioritizing market share over profitability. The strategy was clear: grow everywhere, grow fast, and dominate the flexible workspace market, a mantra that characterized many startups of that era. The immense capital inflow fostered a growth-at-all-costs mentality within WeWork. The focus shifted from achieving sustainable cash flow to rapid geographic expansion and increasing membership numbers, regardless of the underlying profitability of individual locations. New buildings were leased and fitted out at significant expense, often without clear evidence of demand to fill them immediately. This strategy, while impressive in terms of sheer scale and market presence, exacerbated the inherent financial vulnerability. The company was essentially making massive long-term bets on future occupancy rates, financed by external capital rather than strong operational cash flow. By January 2019, WeWork had reached its zenith, commanding an eye-watering $47 billion valuation. This figure, reported by Reuters, made it one of the world's most valuable private companies. Investment banks and venture capitalists lauded its disruptive potential, seemingly justifying the unprecedented numbers. However, critics, including The Economist, openly questioned whether this valuation was genuinely supported by the company's underlying financials and business model. They pointed to the fundamental mismatch between long-term liabilities and short-term revenues, arguing that the market was buying into a narrative of tech innovation rather than a sound real estate enterprise. Despite its impressive revenue growth, WeWork was consistently bleeding money. The S-1 filing, later made public during its IPO attempt, revealed a stark reality. In 2018, the company generated $1.8 billion in revenue but incurred a staggering $1.9 billion in losses. This pattern of losses outpacing revenue growth was a critical red flag for financial analysts. It underscored the high costs associated with its rapid expansion strategy, including expensive build-outs, operational overhead, and the long-term lease commitments that burdened its balance sheet. The pursuit of scale came at an unsustainable cost, a detail often overshadowed by the glowing valuation figures. At the helm was Adam Neumann, a charismatic and often controversial figure whose leadership style was central to WeWork's identity. His ability to articulate a grand vision for transforming work attracted both investors and employees, fostering a cult-like company culture, as documented by Vanity Fair. However, his management was also characterized by erratic behavior, questionable business practices, and a blurring of lines between his personal finances and WeWork's. This became a growing concern for investors and would later contribute significantly to the erosion of trust and the eventual re-evaluation of the company's future. Among the most controversial aspects of Neumann's leadership were instances of alleged self-dealing. The New York Times reported one particular transaction that raised significant ethical flags. Neumann personally trademarked the word "we" and then sold the rights back to WeWork for a staggering $5.9 million. This move, seen as directly benefiting the CEO at the company's expense, caused outrage among investors and critics. It highlighted a significant conflict of interest and underscored a pattern of corporate governance issues that became increasingly apparent as WeWork prepared for its public debut. Beyond the trademark deal, Neumann's leadership was also associated with lavish spending and perceived excess. Reports detailed a lifestyle that included a private jet, extravagant corporate events, and a general culture of opulence that seemed at odds with the company's financial realities. This spending, particularly as the company continued to report substantial losses, fueled investor unease. It created a perception that company funds were not being managed with fiscal responsibility, further eroding confidence in Neumann's leadership and WeWork's trajectory as a sound investment. The moment of truth arrived in August 2019 with the public filing of WeWork's S-1 prospectus for its initial public offering. This document, required by the SEC for all companies planning to go public, laid bare the company's intricate financials and corporate governance structures. For the first time, the true extent of its losses, the complexities of its lease agreements, and the unusual arrangements surrounding Adam Neumann's control were exposed to intense public scrutiny. It was this detailed disclosure that catalyzed a rapid and dramatic re-evaluation of WeWork's actual worth and viability. The S-1 filing revealed significant red flags regarding corporate governance. It detailed how Adam Neumann, despite not holding a majority of shares, maintained substantial control over the company through a supervoting share structure. This arrangement effectively insulated him from accountability to other shareholders. Furthermore, the prospectus highlighted numerous instances of related party transactions and potential conflicts of interest, including real estate deals where Neumann personally leased properties to WeWork. These revelations sparked widespread alarm among potential investors and corporate governance watchdogs. Perhaps the most chilling revelation within the S-1 filing came from WeWork's own auditors, who expressed substantial doubt about the company's ability to continue as a going concern. This rare and severe warning signals that there is significant uncertainty about a company's ability to remain in business without immediate, material interventions. For a company on the cusp of a multi-billion-dollar IPO, such a statement was devastating. It officially cast a dark shadow over WeWork's financial stability and raised fundamental questions about its long-term viability, sending shockwaves through the investment community. The financial trajectory presented in the S-1 filing was alarming. While revenue was increasing, the rate at which losses grew was even faster. In 2018, WeWork reported $1.8 billion in revenue, but astonishingly, its losses for the same year reached $1.9 billion. This wasn't merely a company spending to grow, it was a company whose fundamental operations were burning through cash at an unsustainable rate. The more WeWork expanded, the more money it lost, a clear indication that its growth strategy was divorced from any path to profitability or sustainable cash flow. Facing intense scrutiny and overwhelming skepticism from investors, WeWork was forced to postpone its highly anticipated initial public offering in September 2019. The concerns about its business model, corporate governance, and escalating losses proved too significant to overcome. This decision marked a critical turning point. The market, once enamored with its growth story, now firmly rejected its valuation and operational practices. The postponement was not just a delay, it was a public acknowledgement of profound systemic issues, shattering the illusion of invincibility that WeWork had carefully cultivated. Following the failed IPO attempt, WeWork's valuation plummeted dramatically. From its peak of $47 billion in January 2019, the company's worth rapidly eroded to less than $10 billion, as reported by the Wall Street Journal. This steep decline erased billions in investor capital and vividly demonstrated the market's complete loss of confidence. The discrepancy between the previous inflated valuation and the post-IPO scrutiny valuation highlighted how much of WeWork's perceived value had been built on hype, narrative, and an unsustainable growth model rather than sound financial fundamentals. The immense pressure from investors, particularly SoftBank, made Adam Neumann's position as CEO untenable. In September 2019, Bloomberg reported that he was forced to step down from his leadership role. This move, while seen by some as a necessary step to restore investor confidence, also marked the end of an era defined by his singular vision and controversial leadership. His departure underscored the severity of the financial crisis engulfing WeWork and the desperate measures required to salvage any future for the company, effectively signaling the end of his unbridled control. To prevent an immediate collapse, SoftBank, WeWork's largest investor, was compelled to orchestrate an emergency bailout package. This intervention, reported widely, involved SoftBank injecting billions more into the struggling company, effectively taking majority control. The bailout was a last-ditch effort to stabilize WeWork and protect SoftBank's considerable investment. It reflected the desperate situation WeWork found itself in, unable to secure alternative funding and facing an imminent liquidity crisis, highlighting how dependent the company had become on its main benefactor. Despite desperate measures and management changes, WeWork's fundamental business model proved unsustainable. In November 2023, Bloomberg reported that the company officially filed for Chapter 11 bankruptcy. This filing was the culmination of years of financial struggles, heavy losses, and the insurmountable burden of its long-term lease commitments. The bankruptcy left behind billions in unpaid leases and liabilities, a stark reminder of the consequences of prioritizing rapid expansion and an inflated narrative over sustainable financial health and operational discipline. The story of WeWork serves as a powerful cautionary tale, particularly for the startup world. Its spectacular rise and equally dramatic fall highlight the dangers of unchecked ambition and the pursuit of growth at all costs. The core lesson is clear: a compelling vision and charismatic leadership cannot compensate for a fundamentally flawed business model. The reliance on short-term, flexible revenue against long-term, fixed liabilities, combined with exorbitant spending and poor governance, ultimately led to its demise. WeWork's journey underscores the critical importance of sustainable cash flow, sound financial management, and robust corporate oversight, even in the most innovative and rapidly expanding enterprises.